The US stock bull gene, why can't the market stay down? The recent US-Iran tensions sent shockwaves through global equities, dragging major US indices down sharply in a very short time. But what happened next was remarkable. In less than a month, the US market didn't just recover its losses, it reached new record highs. Meanwhile, European and Asian markets are still working to regain stability. Why does the US market rebound faster than others? Today, DBG Markets takes 2 minutes to break down the bull gene of the US stock market and how you can use it to your advantage. First, it's important to understand that US stocks don't just represent domestic companies. They reflect global businesses. The heavyweights in the S&P 500 and the NASDAQ like Apple, Google, Microsoft, and NVIDIA are multinational leaders. Their revenue streams come from across the globe. Even if US domestic demand slows, as long as global technological progress continues, their growth engines remain active. Investing in US stocks is, in many ways, investing in some of the world's most productive enterprises. Second, the US holds the world's primary reserve currency, the dollar. During periods of uncertainty, capital tends to flow back into the US for stability. During inflationary periods, capital often shifts into high-quality companies with strong pricing power, allowing them to manage rising costs effectively. This is why in such environments, leading growth companies are often seen as relatively resilient assets. Finally, and most importantly, is investor behavior. Because of the first two factors, global investors tend to maintain strong long-term confidence in the US market. Many adopt a long-term approach, expecting continued growth in corporate earnings. This creates consistent upward pressure. When short-term declines occur, capital often flows in to take advantage of lower prices. This ongoing demand helps create a natural support level for the market. Of course, the US market is not immune to risk. It still faces challenges, but it often follows a sharp drop, quick recovery pattern. The more significant risks tend to be long-term and systemic. For example, the aggressive monetary tightening and interest rate increases in 2022 and 2023 led to a more extended market downturn by reducing global liquidity. Another extreme scenario is a severe liquidity disruption, such as the 2008 financial crisis or the 2023 regional banking stress. When the underlying financial system is under pressure, even strong markets can experience prolonged recovery periods. The bottom line: the strength of the US market comes from its global earnings power, dollar dominance, and sustained investor confidence. These factors contribute to its long-term upward tendency. Viewing short-term geopolitical or macro-driven pullbacks as potential opportunities can be a thoughtful approach. However, it's important to stay disciplined and remain aware of changes in long-term fundamentals. This is DBG Markets. See you next week.